This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about money. Today we have a very special guest. It's a longtime friend, Adam Taggart. And he's going to be speaking to us on a subject called bonds. Now, bonds in theory are a very simple subject, but I've never understood them. And the reason I wanted to have Adam on for bonds is simply because, that my friend Harry Dent, he's always saying buy treasury bills. But I'm concerned, if what I think is about to happen is going to happen, which is the demise of the U.S. dollar, the hegemony of it and its power and its reserve status. If the U.S. dollar goes bad and fiat currencies go bad, what happens to bonds? So that's why we have Adam Taggart, and he's on his incredible program, Wealthy On. I subscribe to, the company subscribes to it. And what Adam does on his program, he takes extremely complex subjects, and his commentary dumbs it down for people like me. And what Rich Dad does, we take those ideas and we dumb it down further so everybody can understand it. Any comments on that, Kim?
Well, you just said what I was going to say. So I was just going to say that, it's called wealthyon.com. And yeah, we've watched the videos. The company studies the videos that you put on there, Adam. It is incredible information. And as I was saying before we started, I have to hit rewind probably like 25 times because some of this stuff is so over my head. But to your point, Robert, about the U.S. dollar, we've been studying that and what's going to happen with the U.S. dollar, and is it stock going to be the world reserve currency, and what does that mean? And so we have a lot to talk about.
And the question is, how safe are bonds? Because I have a friend. I mean, he has not a million. He has hundreds of millions in bonds. And yesterday I went and bought some more silver and hid them in my secret mountain vault. But he says, he won't touch silver. He says, U.S. Treasuries are it. So with that question, when he's got hundreds of millions stashed in U.S. Treasuries, he sounded like Harry Dent. So to clarify all this, we brought on Adam Taggart, and he and his former partner, Chris Martinson, they talked about not the dollar milkshake theory, which was Brent Johnson, but they talked about the eyedropper of water and a football stadium. So I think that's a very good metaphor, the eyedrop of water and an entire football stadium. Because I think that the last eyedrop is about to hit because that football stadium's almost filled up. So Adam, welcome to the Rich Dad program.
Welcome, Adam.
Hey, it is a pleasure to be here. It's so great to see you guys again. It's been way too long since we last saw each other in person, let alone virtually. Yeah. And I do just want to say it's such an honor to hear that you guys in the Rich Dad organization watch any of these Wealthy On videos. And I just want to give the compliment right back to you guys, which is you guys were a massive inspiration for me in starting that platform. So in many ways, it's just seeds you planted, the harvest returning back to you guys. So thank you.
Well, thank you. It's fabulous. You take the ultra complex and simplify it, or clarify, should I say. Not simple, but clarify it.
Well, thank you. And really the whole reason why I started Wealthy On was to try to give the average person, the little guy, access to what the experts are thinking and the decision makers on Wall Street are thinking. And of course, those guys tend to speak in their own particular type of jargon. And so really, I just sort of see my role as really just trying to be sort of like the decoder ring that takes complex words they're saying and putting it into terms that hopefully the rest of us can understand.
Yeah. So would you explain the eyedrop in the football stadium? Because it seems like we're very close to that.
Sure. And for folks that don't know the eyedrop in stadium reference, this is really about the power of exponential growth. And a lot of the trends that are sort of driving the world we live in at large are exponential. And the human mind doesn't do a really good job of understanding exponentials. And that's why my former partner, Chris Martinson, came up with this analogy about the magic eyedropper in the stadium. And so basically he says, look, pick the stadium of your choice. we usually use Yankee Stadium because we both were from New England and we're Boston Red Sox fans. So if we were going to destroy a stadium, we were going to destroy Yankee Stadium. So imagine somebody takes a magic eyedropper and walks down to the pitcher's mound and squeezes out a single drop of water right there on the pitcher's mound. And that drop of water doubles in volume every minute. So minute 1, it's 1 drop in size. Minute 2, it's 2 drops in size. Minute 3, it's 4 drops in size. Minute 4, it's 8 drops in size, right? So the question is if you got handcuffed to the topmost bleacher seat in the stadium, how long would you have to escape your handcuffs before the stadium was underwater? And, most people will say, I don't know, a year, months. The answer is very surprising. The answer is 45 minutes, much less time than you think. And that's just because when it doubles, each doubling is bigger than all the increases that came before it. But the really important question is at what point is the park only 3% filled? So like the infield is just covered in like a foot of water, and you can now begin to see, oh, this thing is starting to fill up. What time does that happen? And that happens at minute like 40. So basically, by the time you see there's a problem, the stadium's filled just a couple of minutes later, right? By the time you see the issue, it's way too late to avoid it. Your only choices at this point in time are just to sort of manage the impact. And so I think that's very much what you guys are picking up here, where it feels like we're that far along in a lot of these exponential trends that if you're sitting there hoping, oh, well, maybe somebody's going to come up with a solution and we can avoid this problem that I'm seeing, in a lot of cases, that's not going to happen. And you're really just wasting precious time with false hope. What you should be doing is saying, okay, it looks like this is going to happen. I need to figure out how I'm going to reduce my vulnerability to its full force arrival. That's the right way to use the time we have left here.
And what minute would you say we're at?
Well, it sort of depends, what you're talking about. Are you talking about the functioning of our financial system? Are you talking about the U.S. dollar as a reserve currency? Or are you talking about just our ability to afford our basic way of living? That right now, I think, is getting pretty late in the game, especially if you live in parts of the world that are really suffering right now under just crushing inflation. I don't think anybody in Europe, for example, could have ever forecasted a year ago that they would be paying what they're paying right now for energy.
Yeah.
So when you look at a lot of times in America, can't see because we're a goldfish bowl. Everybody looks in, but we don't see out.
Mm-hmm.
I'm looking at what happened in Sri Lanka, what's happening in Brazil, what's happening in England, what's going to happen in Germany but we can't see it as Americans. And
I think the goldfish bowl is a great analogy too, because goldfish really have like incredibly short-term memories. We just so do we.
So do we.
So I'm sitting here watching all this, and so that's why I keep thinking of the eye drop theory. Said when pitcher's mound is covered and I'm sitting in the top bleacher, how much time have I got?
Yeah. So again, it really depends, and I'm glad you mentioned Brent Johnson's dollar milkshake theory, because I'm gonna bring that into play here in just a second. Real quick though. You're right to be looking outside because collapse happens from the outside in, right? It's the weaker players that fall first. And then those are dominoes that topple over bigger dominoes. And then it all begins to progress toward the center. And yes, we live here in our fishbowl, our goldfish bowl here in the US. We do have a lot of advantages that a lot of other countries don't have. And so we're likely not going to be the first one to fall. We're probably likely going to be the last one. But to find out where we are in the story, we want to look out at the periphery and see how it's doing. And as you just said, Robert, the very extreme ends of the periphery are not doing well at all, right? You've got a place like Sri Lanka that's basically, gone into full collapse, right? Yeah. I don't know if you saw the videos of the people a few months ago storming the presidential palace. You got to remember, like we saw a preview of this happen during the Arab Spring, right? It was sort of put off in the media as, oh, look, this is democracy in action. These are people that are rising up against, dictators and whatnot. That really wasn't the primary motivation for the Arab Spring. It was that they experienced sudden and extreme inflation in those countries, and all of a sudden, people couldn't feed their families or keep them warm. And when you get to that point, you really don't have any other option but to throw out whoever's in power, because whatever they're doing just isn't working for you, right? You're beginning to drown. And so that's what happened in Sri Lanka. And, that's beginning to happen with greater frequency elsewhere in the world. And Europe isn't in that case yet, but it's certainly a lot closer to that destination, sadly, than it was a year ago.
And that's, I don't know if you had the chance to call him, as Andy Schachman. He was Miles Franklin. He's one of the most accurate gold guy I've ever, his macro of the world is precise. But he was talking about in 2019, when Biden abandoned Afghanistan, the next day, Saudi Arabia went to talk to China and Russia. And this is 2019, and just a couple of days ago, Saudi Arabia switched from the petrodollar to shifting to a gold-backed yuan. And nobody even notices that. So Saudi Arabia joined forces with Russia, China, Brazil, India, South Africa. So I have a chance to talk to Andy. His forecasts are so precise, Adam.
And I think, too, some people don't understand when Kissinger cut the deal with Saudi Arabia and said, the petrodollar, said, we will protect you militarily, and in exchange, you're going to sell your oil in U.S. dollars, which has propped up the U.S. dollar. And now when we pulled out of Afghanistan, Saudi Arabia goes, maybe I can't trust you to protect us because you didn't protect them.
Well, that and when Russia invaded Ukraine, basically the U.S. weaponized the financial system against Russia. And a lot of other countries looked at that, basically seizing Russia's assets that were held abroad and whatnot. And a lot of countries looked at that and said, whoa, I'm in the U.S.'s good graces right now, but I might not always be.
Exactly.
And if they could do that to me. So, what we've done in the response to the war in Ukraine, whatever you think about it, we have basically provided a pretty strong incentive for many countries to accelerate their plans to de-dollarize. And that's exactly what you're just talking about with the steps that Saudi Arabia took there. And I have not talked to Andy yet, though I appreciate you putting us in contact, Robert. So I can't talk really authoritatively about that last statement about them switching to, some sort of potentially gold-backed yuan thing. But I certainly have heard a lot of commentary recently about the BRICS countries working on a commodity-backed currency to rival the dollar, and probably going to be priced in gold grams and whatnot. We can debate.
Wait. There's two more things that happened. You had the Nord Stream pipeline was bombed.
Yep.
Was that an accident? Or did it just happen to blow up? And the other thing that happened, the reason you're on today is because when who's the new prime or the future ex-prime minister of England what did she try and do?
Liz Truss, who's already out.
Yeah. She's gone, the shortest term prime minister in history, but because she raised interest rates, whatever she did, she tried to cut and all this stuff, the whole bond market nearly came apart, their pensions came apart, and then they had to bring a new prime minister in already. So all of this is happening, and Americans are wondering, well, who's going to win the midterm?
Well, that is important. Midterms are important.
Great point, which is kind of back to our stadium, where are we on the big picture of where things are headed? We are beginning to see, as things, as you go along an exponential curve, things happen faster and faster, right? And so we're beginning to see more of these really big things that we just really couldn't have ever expected would happen, right? The Saudis are maybe, beginning to reject the petrodollar. England's bond market almost blew up. And to your point, Robert, somebody just sabotaged the Nord Stream pipeline. I don't think I don't think anybody debates that this was an act of sabotage. Now you can talk, a lot of people are pointing fingers in different directions. But we're seeing more of these things that nobody could have seen coming, more of these sort of black swans. And of course, the more they are and the faster they happen, the more the odds of something really systemic breaking and something really bad happening obviously increases.
But a big part here is they want to destroy the hegemony of the U.S. dollar, which came in place in 1944 with Bretton Woods. The dollar became the gold standard of the world, or the reserve currency of the world. And then 781, Nixon took us off the gold standard, and we went from being a capitalist state to a credit state. So everything is floating on debt right now.
Correct.
And I think bonds are debt also. And so when Harry Dent is yelling about you should buy U.S. Treasuries, I said, but I think they're going to torpedo the U.S. Treasury. And that's what we called you, Adam, is because what the hell is a bond?
Is a bond.
You know what I mean? How safe is it? How safe? That was 2019. The repo market blew up again. The last time that blew up was 2008. And the reason the repo market is important is like repossession. Do you know how valuable is the asset that you think is an asset? Are they going to come and repo your dollar, or would they rather repo your refrigerator? Do you know what I mean? What has more value today? So in 2019, that's what blew up also again. How valuable is a bond?
So let's start with explaining what bonds are, and then we'll get into are they a good place to be now or not? Because the answer's it's a little bit nuanced, and it's a sense of like something that might have that might not be something good to be in the long term, might be something good to be in the near term, and I can explain why a little bit later in the conversation. But let's start with sort of what is a bond, right? Let me contrast it with what's an equity or a stock, because I think people understand that really easily, right? A stock is basically just a share of ownership in something, right? I can go buy a share of Apple. It's clear I don't own all of Apple Corporation, but I own, some. I don't know how many shares Apple has outstanding, but let's assume it's 100 million. I have a 100 millionth claim in terms of the earnings that Apple owns and the assets that it has. Right, I'm a part-time shareholder or fractional shareholder in this company. A bond is not ownership. A bond is an IOU, essentially, where you give your money to somebody and they say, okay, I'm going to pay you back. But for the risk that you're taking by giving me your money, I'm going to pay you some interest as well along the way. So it's basically just a contract, and it's just math. Bonds tend to be a little bit easier to deal with because when you're dealing with a stock, you have to take into account all sorts of things. Okay, what's the potential of this company to earn money over time, and what do I discount those earning streams back at, and what's their competition doing, and maybe they're going to take over their category, or maybe they're going to be outcompeted. Bonds, it's really just much more, okay, what's the math of this contract I've entered into with you, and then you have to factor in a little bit of default risk, right? Which is, okay, what's the likelihood this person's actually going to be able to deliver on what they're telling me they're going to do, right? So if you are borrowing from the U.S. Treasury, that is considered, and we can debate this in a minute, but that's considered to be basically about the safest type of debt that you can take on. And one of the reasons why it's so safe is, first, the U.S. is the biggest, most stable player out there on a relative basis, but also we have a printing press. So if we really get in trouble, the Federal Reserve can basically print up the money to give to the Treasury to make sure that they pay you back. So, you are going to get paid back at least nominally, meaning if I give you $100, it's a high likelihood you're going to give me $100 back. Now, if they had to print those $100 to pay me back, then maybe those $100 are devalued a bit by inflation. But again, borrowing from the U.S. Treasury, relative basis, pretty darn safe. Borrowing from a company that's got what's called high yield debt, which is sort of the fancy way to say junk debt. This is a company that maybe isn't profitable, maybe already has a lot of debt on its balance sheet. Its prospects don't look very good. First off, that debt is going to come you're going to demand a higher yield to borrow that debt, right? Or to buy that debt, because you don't trust their ability to pay you back as much. And so that's a riskier debt. So there's sort of a spectrum of bonds that are out there. Those that are considered to be very safe, or those that are considered to be very speculative. And basically, it's the yield on the bonds that differ between the two. A more speculative bond should likely offer you a higher yield because that's making up for the higher risk. So is that understandable so far?
So a longer, Adam, so a longer term bond, government bond, usually would have a higher yield than a short term bond, correct?
Great question. It usually should.
Yeah.
It doesn't right now in the U.S. Treasury market.
Yes. So can you talk about that for just a minute?
Sure. You may hear on the news people talk about an inverted yield curve.
Yes.
And that is exactly what you just discussed there, Kim, which is shorter term bond yields are higher than longer term bond yields. And first, you would expect higher term bond yields to be higher to compensate you for the risk of getting paid back over a longer period of time, right? If I gave you, if you borrowed money from me and we're going to give it back to me tomorrow, well, my duration risk is pretty low, right? I'm going to get it back tomorrow. I'm not going to charge you all that much to borrow it overnight. If you want to borrow it for 30 years, I'm going to say, yeah, Kim, you're going to have to pay me more money because I'm basically giving you my money for a much longer period of time. When people when the bond market gets nervous about where things are headed, and it thinks that something bad might happen in the relatively near term, that then pushes up those short-term interest rates. And so it's basically the bond market telling you, I think in 30 years, things are going to be back to normal. I think we're going to be okay in the long run, but I think we're going to have some rough times in the very near future. And that's why I'm going to demand a higher interest rate in the short term.
Yeah, so let me give you really simple. So you have a 5-year bond, let's say,
yeah,
and you're getting paid 5%, whereas a long-term bond is paying 1%. That's an inversion because it should be the other way. The longer-term bond should be paying 5%, but short-term is paying 1%. That's when the higher math kills me at that point.
Exactly. Now, that would be an extreme example of an inversion, but yeah.
But anyway, the shorter-term bond should be less interest, but today the shorter-term bonds are higher interest than the long-term bonds, and that's the inversion.
Right. And there are probably many factors for that inversion, but two important things about it. One, an inverted yield curve is one of the most dependable signals we have of approaching recession. Right. Yeah. So, if you see an inverted yield curve like we have today, you should say, all right, look, I gotta get prepared that we may be entering a pretty, material recession in the not too distant future, because whenever we've seen this before, it's happened. Right. And right now, as you guys know well, we've got a big inflation problem around the world, but certainly in this country. Most central banks, definitely the Fed, are hiking rates right now to get inflation under control. Now, we have an economy that has gotten extremely used to, some would say addicted to or dependent on ultra low interest rates. That the Fed brought them down to zero at a period of time. It kept them really low, lower than they'd been in some cases in recorded history. And the system habituated to that. So now that rates are rising, they're rising pretty dramatically, right? We've gone from near zero. Now we're around 3%. We're going higher. The Fed is highly likely to hike another 75 basis points at their next meeting, and is talking about going even higher still. And we've raised rates faster than we ever have in the data series. So think about the way I like to help people understand this is, let's say I gave you, Robert, a gallon of water, and I told you you had a week to drink it. You'd have no problem with that, right? But let's say I just shoved it up against your face and I just forced it down your throat all at once. You might actually choke and drown, right? Same amount of water, but it's the rate of change that's the different point there, right? So we're shocking the economy right now by bringing rates up to a point where the economy is not used to rates being this high. may actually not be able to function at rates this high. And we've done it in such a fast period of time that it's literally like shocking the financial system here.
So before we have to go to a break. I'll keep it really simple because we dump it down even further.
Sure.
So what has happened is that as interest rates kept coming down because they wanted people to borrow and stimulate the economy, our debt went this way.
Yes.
So as interest rates came down, the Fed borrowed, not really borrowed, but printed more money, and our national debt owed by the taxpayers kept going this way. But the moment they raise interest rate, that debt is going to kill us because it's too expensive.
Exactly. The debt service payments all of a sudden become a lot more burdensome. And
who pays that? Our taxes. Do you know what
Exactly.
I mean? Who pays the debt? Are the U.S. taxpayer. So mom and pop get screwed again because they use that cash, the low interest rates, to bail out the banks, and that we're in trouble. In 2008, same says all this is going up and down, and that's why I'm going, this is a little too tough for me because I have a simple little brain here. and do you know what? And the question is, because interest rates are going up, prices of gold and silver come down because everybody wants the higher interest rates than gold and silver will pay. So this whole thing just gyrates the entire world. So that's why you're here. So now that we've totally confused everybody with the dollar milkshake theory and eyedropper and interest rates coming down and inversion yield curves going up, we'll come right back and hopefully we'll untangle this can of worms. So we come back and thank you. Thank you, Adam. This is a very confusing show for me. Thank you. We'll be right back.
The money printing is out of control. The Fed already crashed the stock market, and now they're coming for everything else. Take real estate, for example. In June, the Fed said the housing market needs a difficult correction, but Robert called them out just last week. He said, don't get swept up in the propaganda. If the Fed can't print it, invest in it. They can't print oil, they can't print real estate, and they can't print a new Van Gogh masterpiece. That's right. Experts know the art market is ripe for opportunity since it isn't at the mercy of the Fed. Look at the data. While the S&P is down over 24% this year, the art market has soared past its pre-pandemic levels. Now, the average piece is worth 26% more than this time last year. So how do you take advantage of this momentum and invest in art without needing millions? By investing with Masterworks. Robert's talked about them for months because Masterworks lets you invest in shares of paintings by Warhol, Picasso, and Banksy, and the results so far have been incredible. 6 paintings sold for an average net return of 29% to their investors, including a sale as recently as August for a 33.1% return. No wonder their over 500,000 users have invested more than $500 million on Masterworks. And here's the best part. You can skip their waitlist and try Masterworks for free by going to masterworks.art/richdad. That's masterworks.art/richdad. See important disclosures at masterworks.com/CD.
Feeling powerless over current events and your financial future? Financial freedom is your freedom. Robert Kiyosaki is the best-selling author of Rich Dad, Poor Dad. Over 40 million people have taken Robert's advice. Now it's your turn. Attend Robert's free virtual wealth building event. Claim your free access now at richdadfree.com. Don't wait, access is limited. Go to richdadfree.com. That's richdadfree.com.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Listen to the Rich Dad Radio program anytime, anywhere on iTunes, Android, and YouTube. And of course, you can always listen to this program again at richdadradio.com. The reason we record these programs is if you listen to it 2 or 3 times, it might make sense to you. But more importantly, if you have family members, friends, or business associates, please listen to this program 1 or 2 times and then discuss it, because that's how you get smarter. Because the subject we're studying today is, in theory, a very simple subject. To me, a bond is capital. I make $1,000. I spend $800. I got $200 left. I take that $200 and now where can I put it? So if I buy a bond, I can do that. I can buy some chewing gum with it. I can do what I want with it. But I never had any money to buy a bond anyway. I mean, when I was in elementary school, they had to buy U.S. savings bonds. I think they're 1875. And after 10 years, I got $25. It just didn't stimulate me. You know what I'm saying? 1875 to $25. And my poor dad kept saying, it's a good deal. And my rich dad says, you're being screwed, you know, because of inflation. So I was totally messed up by the time I was 10 years old. And so today we're going to mess your mind up even more because we have Adam Taggart on. And it's a very simple subject called a bond. If you had $1,000, where would you put that money? Would you put it in bonds? Would you trust it to the government? There's corporate bonds, there's private bonds, there's so many different types of bonds, muni bonds. And this whole program started because my best friend, who just sold his business for $2 billion and walked away with a lot of cash in his pocket, he's 100% in bonds. I'm going, but what happens if the dollar goes bad? No, it'll be here forever. It'll be here. He buys muni bonds. So I called Adam Taggart up and I said, what the hell's a muni bond now? You know, I'm going, I am so totally messed up. And it's a very simple thing. You got $200 or $2,000. Where do you put your money? And a lot of people put their money into bonds. And then, who was my friend?
Harry Dent.
Harry Dent swears by U.S. bonds. And I like gold and silver and Bitcoin. So this is where do you put your money, but what is the bond market signaling? So that's why we have Adam Taggart, founder of wealthyon.com, fantastic program, because he demystifies a lot of things that most people go right over their head.
And I was just saying at our break that, Adam, you described the inverted yield curve of bonds more simply than anybody else. And so can you just touch on that again? Because it's a huge signal when that yield curve gets inverted, meaning the rates are higher in the short term for bonds than the interest rates in the long term bonds. What could you just quick summary?
Absolutely. Yeah. So the conventional standard pricing of the bond market basically kind of gets stood on its head, which is you would normally expect higher yields to be charged for longer duration debt, but instead it's the shorter term debt that is charging the higher yield. And the reason for that is, as we mentioned, is it's basically the bond market telling you that it's nervous about the short term. And as we were finishing the last segment before the break, I was talking about how fast the Fed has been hiking interest rates. And essentially what the inverted yield curve is telling us is that it agrees with the people who say that, you know what, the Fed's going to keep hiking rates until, quote unquote, something breaks. And the inverted yield curve is the bond market saying, yeah, I agree. I think something's going to break in the near future. And that's why I'm charging higher rates on demanding higher yields for the shorter term debt. So what that tells us is, okay, hey, we should all be, a little bit more cautious, a little bit more defensive right now that, we may be going into a recession because an inverted yield curve is one of the most dependable signals we have of recession. And then we should just be saying, hey, if the Fed breaks something, well, what's likely to happen, right? And this, Robert, is where we get into, are bonds a good place to be or not? And it gets a little complicated, but I'm going to try to keep it really simple. And this is probably why your friend Harry Dent really likes U.S. Treasury bonds right now. So there are a lot of people. My
friend likes municipal bonds.
Muni bonds. Okay. Yeah. And I got to be honest, I personally find it hard to make a great case for muni bonds right now. And of course, I'm making a blanket statement. Just like with stocks, not all stocks are created equal. I'm sure there are some great muni bonds out there right now. But there are a lot of risks going on that I think, that you take on as a municipal bond investor that, given the current macro environment, I'm not too excited about. And I can get into that in a little bit more detail if you want.
Adam, just real quick, a municipal bond is just quick.
Yeah, great question. So let me just contrast it to a U.S. Treasury bond and a corporate bond. So U.S. Treasury bond is basically you're just borrowing from the government. Right. And that's how the government finances how things work. Right. So they agree to pay you back on a certain schedule with a certain interest rate. Great. And your risk there is really the sovereign risk. Will this country be in business long enough to pay me back?
So what you're saying, the government borrows money from you. That's a bond.
Yes, that's a bond. Yep, exactly.
That's the U.S. Treasury, or whatever they call them.
Then there are corporate bonds, which is basically where a company is doing the same thing, right? So
they borrow your money.
Yeah, borrowing your money, agreeing to pay you back on a certain schedule. And in most cases, you're going to demand a higher interest rate or rate of return on a corporate bond than you will a government, because it's much more likely the U.S. government's going to be around than random company X. Now, a municipal bond is a local government that's borrowing from you. This is oftentimes how, bridges get built and, policemen get paid and, things like that, is the local municipality borrows from you and agrees to pay you back on a certain schedule. But you have all sorts of additional risk that go on there. You've got the risks of what happens in that locality. If we have a national recession, is this a area that's going to get hit worse or less by what's going on? Are people moving in or out of this place? Are they going to raise taxes or lower taxes? There's all sorts of other risk factors that can go on there.
Right. And Matt threw in a curveball on that. I think he likes muni bonds because he says they're tax-free or something.
So you can get tax benefits from them, yes. But
is that true for all bonds or just muni bonds? Depends.
It depends. Not from corporate bonds. A lot of U.S. government bonds are exempt from state and local taxes, but not from federal taxes. A lot of muni bonds are kind of the other way around. So your mileage varies here. And I think just to put a cap on the muni space, if you're going to invest in a municipal bond, I would definitely do so under the guidance of somebody who really tracks them and can pick out the wheat from the chaff for you, because there are so many different variables that go on there. And one of the things we're going to talk about in a minute is this recession risk that the inverted U.S. Treasury yield curve is warning us about. I talk for a living on Wealthion. I talk to economists and investors and market analysts. I do it 5 to 6 days a week. And the vast preponderance of them are all pretty concerned about both the depth and the duration of this recession that it looks like we're heading into. So, a lot of people sort of think that, okay, well, if we get into a spot of trouble, the Federal Reserve's going to pivot, and they're going to do what they did back in 2020, right? In 2020, we had a recession, but boy, it was a very, very short-lived one, and then we got a ton of stimulus, right?
The pivot, as another term, pivot means right now they're raising rates. The pivot, they'll go back to dropping interest rates again, and then print more money.
Exactly. That it means that they would reverse their current policy. So their current policy has been hiking rates and beginning to tighten their balance sheet, which basically means they're withdrawing liquidity from the system. And this is after a decade plus of keeping interest rates super low and pushing liquidity into the system.
Okay, right? So let me show one more diagram. They dropped interest rates down, but debt went up. And so when they hike interest rates, the price of that debt gets more expensive. Is that correct?
That is exactly correct.
And that's what happened in England just now. That's what happened in England.
Well, that is what happened. So we could have an entire show on kind of the bad policies that have been pursued that have gotten into us into this huge trouble where we have way too much debt in the system, and it's killing our economic growth prospects. And the problem is if we keep using the old medicine to try to limp things along, we're just making the problems even worse. So if we try to, tighten our belts and try to, use austerity to try to, reverse the worst of what we've created, we actually start sending the system into shock and it starts threatening to collapse. So we don't really have a good road to a good path to go down. Whichever path we pick here, there's an increasing instability that comes along with it.
Yeah. So may I go back to you and Chris's analogy of the eyedropper? We're at Yankee Stadium, and you're noticing that the pitcher's mound is kind of getting covered with water, and you're on the top bleacher saying, well, how much time do I have?
Right.
That's
we
exactly
know now
what we're talking about
again. You don't have much at all. Yeah, exactly.
No, because it'll go poof.
Right.
Is that what
So
you're
let me get to the chase of what I believe your question is, which is how much time do we have, right? And it really depends on where you are in the story, right? So some players have a lot less time than others, and I would posit
in age?
that. Pardon me?
Age or?
No, more just sort of like other countries are going to fail first before we do.
Okay,
Other countries,
good.
other currencies are going to fail
Have
first
less
before
time.
we do. Yeah. So, if you're looking at let's look at currencies. So, right now, the other world major currencies are having a much worse time than the US dollar is, right? The Japanese yen is basically in free fall right now. I think it's lost definitely more than 40% of its value over the past year, maybe even more right now. The euro has gotten down to parity, below parity, even with the dollar. The pound has almost gotten to parity. It hasn't been there for decades. So we're already seeing other players stumble harder and faster before us. And you had talked about the dollar milkshake theory that Brent Johnson mentioned. And I'll try to keep it really simple for folks.
Good.
What it basically says is that as the rest of the world stumbles, and they are more likely to stumble
First
before we do, and probably worse than we do, that creates a global demand for dollars.
Right.
And that props up the value of the US dollar. And that's exactly what we've been seeing this year. I just told you how much it's appreciated versus all the other major fiat currencies.
So one second. So that's why gold and silver come down, because the dollar keeps getting strong. In dollars, I mean. In US dollars.
Yes. And what's so interesting about that is...
But in yen, gold and silver are going up compared to yen.
I was going to say, if you own any other currency besides dollars, your gold has appreciated dramatically in your local currency. Right. It's only in the US that it hasn't. And that's because the dollar has been so strong this year. And that's because of the dollar milkshake theory. So I emphasize that because there's a lot of people who ask a lot of the same questions you were asking, Robert, which is, well, all right, so I heard this thing about Saudi Arabia and we've got all this debt. And so is the US dollar just going to become toilet paper overnight? Basically, the dollar milkshakes theory says, look, like it or not, and Brent Johnson is not a fan of the US dollar. He thinks there's a lot of problems with it, but he just says it is the cleanest shirt in the dirty shirt laundry hamper. And we have a lot of advantages still, some of them fair, some of them unfair, that are likely going to prop the dollar up for an awful lot longer than most people imagine. He says at some point in time, yes, there will be a reckoning with the US dollar, like there will be a reckoning with all fiat currencies, but it is highly likely to be the last domino to fall. And another part of the dollar milkshake series says, in addition to propping up the value of the dollar because there's this global demand for dollars, a lot of foreign capital is going to just find its way into the US market anyways, because it's going to be seeking stability, safe haven, and return. And so that's something that, as bad as what might be coming, is the U.S. capital markets may actually fare pretty well on a relative basis because you just have this flood of outside capital coming in. Again, not necessarily very fair. And for those who have legitimate concerns about the U.S. market and the U.S. dollar and the U.S. capital markets, it doesn't negate them, but it basically says in the relatively near to midterm, we may actually be the source of strength.
I have a question.
Yeah.
I have a question. You say as long as the U.S. dollar is in high demand, what would cause that demand to slow?
It's a great question. So obviously, a really big one would be, if there was a competing currency on the global scale, something that could either remove the U.S.'s reserve currency status, or at least give a credible alternative that diminished demand for it.
Can I add one more thing?
Yeah.
You have dollar milkshake there, the eyedrop thing, but if your eyedropper is filled with yen or pesos or euro, it's going to come faster than the dollar, U.S. dollar, I'm saying.
Well, absolutely. And that's why you have to worry if you live in those countries.
Right.
So like if you live in Japan, you have to be preparing for
now.
Like how much time do you have left? you've got an awful lot less time than the folks sitting in a stadium inside the U.S., right? And that's why I said kind of where you are really matters in the story in terms of how much time you have left.
Thank you.
And so a competing currency, going back to what would slow the demand for the U.S. dollar, isn't that what BRICS is discussing right now?
It is, and I'll tell you, I'm going to be like Brent Johnson, which is, he talks about the strength of the dollar, even though he doesn't like the dollar, right? I welcome competing currencies, right? I think it just makes the world a more efficient, a better place. There's a lot of worries that folks have that are justified around the U.S. dollar and also other different types of fiat currencies. I would love to see competing currencies that are backed by some hard asset, right? And that seems to be, what's rumored that the BRICS nations are working on.
I mean, people, BRICS stands for Brazil, Russia, India, China, South Africa. And just last week, Saudi Arabia joined the BRICS.
So we put an extra S on there too. And people also kind of lump a lot of the, resource exporting developing nations around that. So, kind of roughly a lot of the South American nations and whatnot too.
Plus Nigeria is going to join the BRICS.
Yeah. A lot of.
So they're ganging up on the dollar.
That I think is that's the logic here. Now, I want to caution all this by saying, people have long said, oh, the yuan's going to replace the dollar. And even earlier this year, people were saying, well, Russia's going to back the ruble with gold, and that's going to start to displace the dollar. It's a very, very hard thing to displace a global world reserve currency, especially one that's as integrated and deep as the U.S. dollar market right now. There's just a sizing issue that even if, say, the yuan wanted to do it tomorrow, it would be a long road for an already established major world currency. So for something brand new to come out into the scene, it's going to take, I'm going to guess here, but I'm going to say at least a decade, if not maybe several, to really start stealing substantial demand from the dollar in terms of where the currency status.
So Adam, that's why I recommend you invite Andy Schectman on board, because his insights, I found them profound. Like he was saying that Saudi Arabia joined the BRICS, or Russia, China, the day after they abandoned Afghanistan. Biden did. And also what happened in 2019, the BIS, the Bank of International Settlements out of Switzerland, the central bank, they listed gold as a tier 1 asset, replacing dollars and bonds, U.S. treasuries. So all of this is so macro, we can't see it. And so what I'm going to ask you to do is we're going to take a break. We're going to ask you to stick on for another 15 minutes to do our best to unscrew our minds. But the big point here, the reason I started with your eyedropper and the dollar milkshake theory was basically saying that the U.S. doesn't care that the money is in Brazil. We're going to suck the money out anyway. The U.S., there was a book called Confessions of an Economic Hitman, and it said that what we would do is we would lend countries money, but they had to pay it back in dollars. So if you
basically turn them into our debt slaves. Yeah, that was John Perkins.
And that was the purpose of the U.S. dollar. So all of this stuff I've been reading, and the more I read about it, the more confused I get. So that's why you're on this program, Andy. I'm a very simple U.S. Marine. I buy gold, silver, and Bitcoin. You know what I mean? That's about all I can handle because I don't have to worry about anybody else owning what I own.
Right. And I know we're taking a break here, but I do want to underscore I own all those assets as well. So we can talk about that too.
Yeah, and we're not recommending them. We're just kind of explaining what the hell is going on. Like I was on, what's his name? His show, and he says, what do you recommend? I said, I recommend tuna fish. Cans of tuna fish. He goes, why? I said, because it takes diesel to catch tuna. And he goes, what does that mean? I said, well, the price of diesel goes up, the can of tuna is going to go up, but the U.S. dollar is going to come down. That was Bill O'Reilly. He lost it. I mean, he lost. You say invest in tuna fish. I said, oh, at least you can eat it. And, if Safeway or Albertsons, one of the big supermarkets go broke, they can't come after my tuna fish. I own it now. And so I just keep it as simple as possible. When I buy a gold coin or a Bitcoin or a U.S. silver to Eagle, I own it. The mint can't come in. Well, they theoretically can't come and get it from me. It's the same as a can of tuna fish. Safeway goes bust, they can't reclaim my tuna fish. Anyway, we'll come back. We're going to give you 15 more minutes into this subject because it's a macro subject. And remember, right, what Adam was saying, if you're living in Japan, the eyedropper theory is about to take off. Rickard says, he calls it the snowflake. It's that last snowflake that sets off the avalanche.
That starts the avalanche.
Yeah, and so that's we're very close to the last snowflake and the last eyedropper. And the question is, what's safe? We'll be right back with Adam Taggart. Welcome back, Robert Kiyosaki, the Rich Dad Radio Show. Today we have a very special guest, Adam Taggart. He has been a friend for years and years and years. And his program is called Wealthion. Our company listens to it. Please subscribe to Wealthion.
Wealthion.com.
Wealthion.com, because he takes it ultra complex and dumbs it down. And our job is to talk to all of you guys who are dumber than me. We're going to dumb it down even further. Like I said, what's safe right now is a can of tuna. I got one for 20 cents the other day. And there's no counterparty risk to my can of tuna because if Safeway or Albertsons or whatever goes broke, I still own that tuna. But if I buy a share of Safeway stock and Safeway goes down or Albertsons goes down, my stock is gone too. So I think tuna fish are the safest of all investments today. So anyway.
And leading with that, Adam.
We're coming. What's safe today, Adam?
Yeah, what is safe today?
I actually love that example, and I think.
Don't encourage him.
Don't
encourage him.
For the big risks that we've been talking about, right? The risks of, say, fiat currency risks, right?
Fiat stands fake.
Yeah.
Fiat is fake. Government decree money. This is
Right,
money.
so-
I say, because I say it is. That's what fiat means.
Right, and backed by nothing, right?
Nothing.
And we know that when faced with, hey, we've created an issue here, and we either have to tell the populace that everybody's going to sacrifice and tighten their belts, or we could print up more money. They're always going to choose to print up more money, right? So in printing more money, that results in inflation. We're living basically with a very current in-your-face reminder of how excess money printing and largesse from politicians creates a very painful cost of living problem for people, right? So I don't need to convince anybody of that because we're all living through that right now. So in both cases, to protect yourself against the abuse of currency and the rising cost of living, hard assets are, I think, one of the safest long-term assets that you can invest in right now, particularly hard assets that create an income stream, because most hard asset income streams will adjust along with inflation, right? So this can be real estate, which you guys talk an awful lot about. This can be commodity producers. But to a certain extent, Robert, I mean, maybe you're saying it tongue-in-cheek, I don't know, but like stocking up on extra cans of tuna right now is not a bad thing, given where food prices have been heading and can continue to head. Right?
And remember,
you buy a bunch of cans at 20 cents right now, and in 2 months, you'll be super glad when they're selling at 40 cents.
Yeah, and tuna is a derivative of diesel because it takes diesel to fill the shipping fleets up. And so,
and most people don't understand the absolute essential role that energy plays in the economy, because nothing happens. No economic activity happens without the energy to power it. And if you care about the pricing of things, which is what you're talking about here, Robert, you have to be aware of what the energy input costs are for that individual product. And, most products require a lot of energy to happen, right? To your point, if you want to get a tuna, well, yeah, it's a fish in the ocean. You would think it's, hey, no energy is involved at all, but you got to basically manufacture the boats to go out there and fish. You've got to put the diesel in for those boats. Then in most cases, most fish that's actually sold in America and caught off American shores is actually sent to China first to be processed before it comes back here and is put in the can. So, there's just a ton of energy, embedded energy that goes into everything. So you're exactly right, Robert. You've got to really look at your vulnerability to energy costs. And again, I don't have to explain to anybody, they've gone bonkers over this past year, given what's been going on with global supply chains, the war in Ukraine, et cetera.
Yeah, and so I was in Safeway a couple of days ago. They had 5 cans for $1 with tuna. So I scooped them that, man. I said, I'm loading up on this. That's how simple I like to keep things, Adam.
Well, and so I think, from a practical standpoint, we're getting real practical here. This is not a bad time that when you see things on sale, when you're in the store, buy extra, store it up. You'll reduce likely your future grocery bills. There's also, I don't think in the U.S. we need to worry too much about this right now. But if you're in other countries, for sure, there is some of the political instability that we talked about earlier, the Sri Lanka type of instability. Having just sort of the personal resilience of having maybe a deep pantry that lets you get by for a month or two, if there's chaotic stuff happening outside, or God forbid we have another, freaking pandemic lockdown.
Can I give you another example? Andy Schechtman, again, who I really encourage you to interview on the bricks and the.
Oh, I definitely will.
But he talks about it's the roll of toilet paper theory. We're getting to the basic level here. It says, you don't worry until you see the roll coming up.
Until you see the cardboard. Until you start to see the cardboard.
The cardboard's getting close, and that's just total human nature, right? So if you can buck that trend, if you can be the guy that is really paying attention to where the puck's headed and accumulating your stuff beforehand, so that when everybody panics, you are already fine, and you're not contributing to kind of the hoarding buying frenzy. There's just all sorts of reasons to do what you're talking about there, Robert. But also, I want to get back to the topic of bonds because, what's safe? Safe is a relative term.
Right.
I think for the long term, there's lots of great reasons to own hard assets. But I actually think that one of the best investments right now for capital in the relatively short term are several bonds that are out there. I think U.S. Treasuries are actually, they're providing a return that they haven't provided in years at today's rates.
Is this what you call I bonds? Or is that different?
I was about to move on to I bonds.
Oh, okay, sorry.
Let me put a pin in I
I saw a video of yours.
I'm really glad you brought them up, actually, because this week there's a really important deadline if you're interested in buying I bonds. And folks, I bonds probably are the best deal out there right now from a risk return standpoint.
What does I stand for?
Inflation.
Okay.
They are, it's Series I, actually.
Oh, Series I, okay.
Is what the Treasury calls them, but they're basically an inflation protection bond.
Okay.
And let me just finish Treasuries real fast, and then I'll go to I bonds, which you also buy from the U.S. Treasury. But U.S. Treasury bonds are providing a good yield. So you could just park your money there right now. And let's say we do have a big recession next year. Let's say the bear market in stocks and bonds continues. You can ride all that out, get your principal back in a year, plus a nice interest return, and then have dry capital in a year, dry powder in a year to deploy into other assets at better valuations. That's not too bad. Now, if the Fed actually breaks something and we get that Fed pivot where the Fed shifts from hiking and it's forced to go back to lowering rates, that'll actually increase the value of U.S. Treasury. And you can sell it into the market if you want and make a nice gain. Right. So from a risk return standpoint, U.S. Treasuries look better right now than they have in forever.
In short term.
In the short term.
Okay.
To your question there about I bonds. So I bonds are designed to protect your capital from inflation, and as measured by the CPI. And we could have a whole separate discussion as to whether the CPI actually tracks real inflation or whatnot. But
is it really legitimate? Is a computer price index is what Emma's talking about, CPI. And some people question the measurements they use to keep the CPI up or down. They manipulate that also, as some of the suspicions out there.
Exactly, and we could talk for a long time about that, but it's the only game that's being offered. So let's talk about how that game works. So based on the increase in the CPI over a 6-month period, that's what determines what rate the I bond is going to pay you, and they basically change their rate twice a year. And the reason why this is important is right now, I bonds are yielding 9.62% for the next 6 months. which is a very high rate of return, just like a U.S. Treasury with an I bond. You get all of your principal guaranteed returned to you, right? So you're not going to lose
by the
any
U.S.
money.
government. By the
U.S. government. Yep. You're not going to lose any money nominally, and you're going to receive the interest payments that they pay you in the interim. Now, the good news is we actually know what it's going to re-rate to after that. It's going to re-rate at about 6.4%.
Wow, 3%. 3% drop.
Yeah, it's a 3% drop, and that's just because the increases in CPI have been getting lower and lower. And honestly, I think the CPI is going to go down going forward from here because the Federal Reserve is trying to make that happen by raising rates high and slowing the economy. So the reason why I'm kind of harping on this is I don't think we're going to see a rate this good maybe ever in our lifetimes. So
the I-bond rate.
In the I-bonds, right? So you're going to get that 9.62% for the first 6 months, and then the 6.848% for the next 6 months. You blend those together, it's a little bit over 8%. So you're going to get over 8% for holding an I-bond for the next year, and you get all the same assurances as a one-year Treasury. So you could own a one-year Treasury at 4.5%, or you could own an I-bond at 8%. Who wouldn't want to own the I-bond?
May I throw another curveball at you? What is a TIP then?
A TIP is a Treasury inflation protected security, and it operates a little bit different than a TIP. It is probably harder for the time we have here for me to make it really simple for folks. All I'll say is there's a video on Wealthion. If you go to youtube.com/Wealthion that I created, I've got a couple of videos explaining I-bonds themselves, but I've got one video that explains the difference between I-bonds and TIPs. I will say that right now, if you had to buy one of the two, the I-bond is offering the best opportunity here in the short term.
Yeah.
And there was liquid too. You can get in and out of them.
A year.
Yes, the TIPs you can get in and out of really quickly. Real quick with the I-bond, you have to hold it for a year. You can sell it anytime after that if you want to, but you're locked in for that first year.
And if you want to know more about I-bonds, I watched a video of yours, Adam, with you and George Gammon on YouTube when you were talking about it. So it was fascinating. So if you want to learn more, go to YouTube and find George Gammon and Adam Taggart.
Adam, I think we're out of time. We've gone overtime. In fact, I really want to thank you.
There's so much we can talk about.
Oh my God, this is
just the tip of the iceberg. Talk about
like
tips.
Rich Dad likes to keep it even simpler, so buy cans of tuna. You'd be far better off.
We're going to go in the tuna business.
But if you're working in Japan, you have yen. Buy tuna fish as soon as possible.
Yeah, and boy, if you can get any tuna bonds,
there you go.
So, Adam, thank you for your wealth of knowledge, and I'll encourage everybody to go to Wealthion. And any comments?
No, I just appreciate your time, Adam, and your expertise and your podcasts. And please watch Wealthion.com because you have some of the most amazing guests and most amazing information.
So, ladies and gentlemen, we'll be right back for our final word, but I want to thank Adam Taggart, and the question is, what's safe today? We'll be right back for the final word. Welcome back. Robert Kiyosaki, the Rich Dad Radio Show. Good news and bad news about money. Once again, listen to Rich Dad anytime, anywhere on iTunes, Android, and YouTube. And all of our programs are archived, which means we hold in storage at TheRichDad.com. We do that for one primary reason. You can listen to this again, but more importantly, friends, family, and business associates, I would get together, listen to it. And that's what we do here at Rich Dad. Everybody listens to the same one podcast, and we discuss it because everybody has different points of view. People hear different things. But we're also, one more thing, we're purely informational and educational. We don't make any recommendations, although I-bonds look pretty good too.
They look pretty good right now. All right, go check those out.
I got enough tuna fish in my closet. So anyway, I got enough gold and silver hidden in our safes in the mountain. But anyway, we're always going to learn more. So please discuss it with friends, family, and business associates, and you'll find out how much your brain goes, boom, explodes. Any comments there, Kim?
Oh, this was a fabulous show, and Adam does keep it very simple. And as I said earlier, that was one of the best explanations of an inverted yield curve, meaning that your short-term bonds are paying a higher interest rate than the long-term bonds, which is upside down. But what it means is that something is coming, and number one thing it means is a recession, most likely. But then the
it could
bond
be worse.
Yeah, it could be worse because the bond market, the reason their short-term bonds are more have a higher yield is because they're worried. That's the main thing I got. They're worried. If the bond market is worried, maybe people better wake up, and maybe you better get worried too, and make sure that you're prepared for whatever is going to break.
Yeah, America has what's called a dew line, DEW. this distant early warning. So in the financial markets, it's called the bond markets, are signaling something is about to happen. What are your comments there, Sarah?
Well, I finally have my definition of a bond. When Robert had, get Adam on, let's talk about bonds. I was like, good, maybe I'll finally figure out what one is. But it's so simple. It's an IOU that's paid interest.
Yes.
That's so simple.
Yes.
So I'm glad we did this show. But this is kind of funny. I was writing down some notes, and we talked about milkshakes, dirty laundry, tuna. I mean,
I drop her.
Toilet paper.
Very educational around here.
But I also with the bonds, I also like that he explained what the different kinds of bonds are and the different risks that the different bonds have.
Agreed.
So that was very valuable today.
Yep.
And I really I knew nothing about I bonds because I've never had any money. I always borrowed money to invest, but now they have extra money coming in. I've got to open my brain up and look at what kind of bonds are available.
Yep.
So again, I want to thank Adam Taggart, Wealthion. I thank all of you listening to the Rich Dad Radio Show. This is a longer program, but it's an important program. Please share with friends, family members, business associates, and discuss it several times because it'll open your minds to what's going on in the real world. Thank you all for listening.
Thank you.